Hi, I'm Mark Baines, the Senior Lecturer for the QP Module 12 course here at Kaplan. Out of the final 4 professional level QP modules, M12 is the hardest to pass as it has the widest number of topics of any of the other modules. Self-study is often slow going with no idea whether what you are studying is important and exam focused. In my course, you'll receive an exam-focused set of notes breaking down the syllabus area into 16 chapter areas, giving you the knowledge whilst practicing the most important questions needed to pass. The QP Module 12 exam tests your ability to think like a senior advisor, requiring high-level, strategic, financial, and risk management decisions. Questions often won't tell you which theory to use. In my course, I'll show you how to analyze the question requirements so you can select the best theories, techniques and models to use that score the highest marks to pass. In this demo lecture, I'll show you the wide topic areas of QP Module 12 and the popular technical area of long-term financial management.
Hi, and welcome to this QP Module 12 demo lecture. In this lecture, I just want to give you guys a feeling for the course and how I deliver the materials and get you guys past through the actual exam. And first of all, I'm going to start off with my set of notes. In my course, you get 5 sets of notes, around about 600 pages, and we go through each and every page. If you understand and can learn and apply, you'll get a very, very good pass in QP Module 12. The first thing I do is a little introduction. We need to spend time thinking about, before the actual exam, what's important is learning the areas, certainly before the hot topics come out, where I do an additional hot topic review video. We need to get familiar with the syllabus, and we talk about before the actual exam, and then what to do during the actual exam. Case study technique is what I'm famous for, and we spend quite a bit of time on the introduction into that. And then we start getting into detail into our chapter areas, and you'll notice here, if you've looked at the learning pack, QP Module 12, I rearranged the learning pack to make it easier to learn. So typically this is what they test in section A of the actual exam, where we're coming up with business strategies, we're trying to improve the performance. We need to start thinking about ethical decisions as well along the way when we start choosing our strategies, but ultimately, hopefully, when we measure our performance, we can see it being improved. One of the major difficulties, though, with this QP Module 12 is the areas it's testing. It's almost like 3 QP modules in one exam. It's got several subject areas. We've just seen strategy, ethics, performance, but there's a big host of areas here on financial management. Risk management is very technical. We're going to get into a little bit of financing and investment here in this little demo lecture. And you can see, because this is about 3 QP module exams in one, the pass rates here for QP Module 12 are the lowest. But not to worry, you're in very, very safe hands. So like I mentioned earlier, we talk about what to do before the actual exam. I also then start getting into what to do during the actual exam. We start getting into lots and lots of case study techniques. And after that, we then start getting into our big picture. We need to be able to see how all the areas of QP Module 12 fit to one another. So this is all in my introduction. The introduction's quite lengthy, and towards the end of my introduction, we then start looking at the actual exam and trying to break it down into the subject areas. Strategy, you can see here, chapter 1, very, very popular in recent exams. We're going to spend on this demo lecture the most popular area. We're going to spend time here. This is on our chapter 7, long-term financial management, therefore. And we're going to start that chapter with a little mind map. So let's move on to our chapter 7. So this would be now in the classroom. We'd first of all start our chapter 7 by spending some time looking at the mind map, looking at the areas that we've got within chapter 7. So look, we're thinking here about raising finance. what is the finance needed? The finance required, the needed finance. This comes from our chapter 1, chapter 2, when we start thinking about strategic projects. If we're developing a new product, that's going to require some finance. If we're thinking about maybe opening up overseas, that's going to require some financing. And so in chapter 7, we start thinking about long-term financial management. What I do in my set of notes, we get into greater detail and show why equity is high cost, low risk. We do that first of all by learning, then I've got lots of examples, and then we do question practice. Debt's the same, we introduce it, we do examples, we do lots and lots of question practice. Also, when we start thinking about long-term financial management, we've got to start thinking about the return to the shareholders and things like dividend policy. We're also thinking about the mix of our equity to debt, and so there's more theories here that talk about the effects on things such as the WACC and the effects on things like business valuation. Now, what I've chosen for this demo lecture is one of the most technical areas, and it's where we're risk adjusting through what's known as the CAPM model. So I'll show you what I do. This is normally spending many hours, so appreciate this is only a short little demo. But later in my set of notes, we then start getting into our WACC. And you'll see the WACC here is a popular area. So in my set of notes, I show where it's been tested. We introduce here the model. So here it is, the WACC. It's actually a little simple weighted average. Actually calculating the WACC is not too difficult. The problems are calculating these. It's calculating KE, or what's known as the cost of equity. It's calculating the cost of debt after tax, or our KD. So these things here are tricky. So what I first of all again introduce here is another mind map showing you the various difficulties and tricks that we can get in the actual exam. For this demo lecture, I want to spend time here on the cost of equity, because there are two models that they can test here to calculate the cost of equity. There's what's known as DVM. A little later on in my set of notes, you find out that DVM is the dividend valuation model. So if you're being given dividends in your actual exam question, it's because they want to test the dividend valuation model. Or if they're giving you things here such as betas, this is the area I want to focus on. CAPM's actually a better model because this incorporates risk. We're going to see this beta of equity here. This is incorporating risk. But again, I just want to give you a little feel for what we do. Let's just go back to the dividend valuation model. I introduce first of all what it is. Again, we go through examples, and then we've got exam questions, and the same with the CAPM. What I first of all do is I introduce what the model is. So here it is. Here's the calculation of it. Calculating it is actually not too tricky. We just need to be aware of the tricks. Sometimes they can call things like risk-free rates different names, or average returns on the market, or equity risk premiums, or equity betas. These are all explained in my set of notes. Again, we go for examples. We explain further about what is this equity risk premium and the equity betas that represent systematic risk. So we go into lots of detail here, maybe spending about an hour on this area, going into unsystematic, systematic risk, and then further detail into the equity beta and what do betas measure. Well, betas measure risk, and if you've got a beta of 1, then that represents here average risk. So we do lots of examples, lots and lots of questions, but what I want to do on this demo lecture is spend a little bit of time here on a very popular area recently. Look, you can see adjusting the equity beta. We've had a couple of questions on this recently. So what is this risk adjusted WACC all about? Well, this is what we need to look for in the actual exam. If you've calculated the existing WACC, so the WACC at the moment, well, that WACC at the moment should only be used as a discount rate for new investment projects if the business risk and the financial risk are the same. What you're looking for in the actual exam is a little trick where they're changing things. So two things they can change. They can either change the business risk of the new project. So if we're investing in a different industry, that will be different business risk. Or they can change the financial risk. That's the mix of equity to debt. Debt gives you financial risk. Debt is fixed. Debt must be paid. If these things change here, investors will expect a different return. If risks change, returns. They will want, if there's got higher risk, they'll want a higher return. And then this is when we then need to start calculating this risk-adjusted WACC. It involves ungearing, re-gearing beta factors, and to adjust these beta factors here, this is the formula that we use just here. Except we can take a little shortcut in this little formula here. This formula is linking the ungeared beta assets with the geared equity betas and betas of debt, but this debt beta is actually beyond the M12 syllabus. It's something that we go into in CFA, but in our QP Module 12, we don't need to go this deep. So often if they don't tell us, we assume debt is risk-free. So if this debt beta is risk-free, if it's 0, it removes this part here of the formula, and the formula that we need to be aware of and we need to be able to use for the actual exam is this little formula here, just linking the beta asset and the beta equities. I go through some of the assumptions here, some of the limitations. Of course, in practice, debt is not risk-free. If a company's got a higher debt-equity ratio, that can mean a real risk of bankruptcy and insolvency. Risk lenders may not get their money back. But what I want to do in this short little demo video is give you guys a little feel of what this area is about and how I teach this. So always before I start getting into exam questions, I first will start off with some simple examples. Once we've learnt the simple example, we can then build the knowledge up and start getting into greater detail in exam standard questions. So let's have a look here at what we've got in this scenario. We've got a company here, let's say this is our company at the moment, a travel company, we're told it's company A. And if we look at what they're asking us here to do in the requirements, we're being asked for a suitable cost of capital to apply for the NPV of the project. So when we discount NPVs, you guys will know in the past you're being given a discount rate. Well, that's actually the cost of capital that we use as a discount rate. And in QP Module 12, it's popular to ask you guys to calculate the cost of capital. So let's have a little look what this travel company does. It says at the moment here they've got a debt to equity ratio by market values of 2 to 5. So if we just write this in, this is going to be our company's financial risk. Risk is always the amount of debt to equity. So like I mentioned earlier, debt is fixed, you've got to pay it, so this gives you risk therefore. So we're being given here a little debt to equity ratio. We're also being told that they've got corporate debt that's risk-free, so again the debt beta 0, so again look, we can ignore that part here, the formula. If they don't tell you it's risk-free, as I said earlier, you normally assume the debt is risk-free. So we can ignore that part of the formula. It's just this part here we're going to be focusing on in a second. Let's carry on reading. You can see here they're wanting us to use the CAPM model. They're giving us beta values. We're being told there, look, 1.1. We're being given returns on the stock market and risk-free rates. So CAPM is what they are wanting us here to use. Now, normally, if we are a travel company and if our business risk is not changing, so let's say that we're expanding here the travel business, same business risk, and if the ratio of debt to equity doesn't change, if these things are the same, you can calculate the existing WACC. But we need to look very carefully in the actual exam. Are the business risks changing or are the financial risks changing? And if we just read a little bit further on, this is what's important now about Company A. This is our company, remember. It says they're now proposing to invest in a commercial property project which involves diversification into a new industry. And what that means is, if we are investing into a brand new industry, this existing beta that we've got here, that would not represent the business risk of this new industry. Look, you can see the business risk now is changing. So we need to recalculate a risk-adjusted WACC. How do we do that? Well, first of all, step one, you need a beta of a company that works in that industry. So let's just carry on reading this little example here and look. It says quoted on the Hong Kong Stock Exchange. We've got another company here, Company B. Their business is currently involved in commercial property. So that's very, very good. You can see that here, that beta there of 1.59 would represent the business risk of this new industry that we're investing in. So can we use that straight in the CAPM model? Well, just hold on 1 second here. Look, we've got different financial risk to Company B. If you look, Company A, they've got 2 to 5. If we look here at the debt-to-equity ratio by market values of Company B, you can see here, look, Company B now, this is their financial risk. You can see it's different to our financial risk. Finally, we're being given a little profits tax rate there for the adjustments. What we're going to need to do is we're going to need to adjust that beta of 1.59. Now, again, before we start going through all the steps and the calculations, let's just introduce the big picture here of what we're trying to achieve. Let's go back earlier. Earlier in the course, you can see earlier I introduced CAPM and betas, and we talked about a beta of 1 earlier on. So what does a beta of 1 represent? If you've got a beta of 1, it means the returns you're getting from a company share is exactly the same. It's the same as the average return for the market as a whole. But as you've just seen here, different companies have different betas. And the reason why companies have different betas is to do with this. First of all, let's start thinking about business risk. One way of thinking about the business risk is thinking about the fixed costs to the total costs. This is looking at a company's cost structure, or sometimes called operational gearing. And you'll find that if the company's got higher fixed costs, that gives higher business risk. Why? Let me give you a simple example. The problem is, if you've got lots and lots of fixed costs in your cost structure and you sell less, sales volumes go down, let's say by 10%, we sell less. The problem is, fixed costs remain fixed. They don't go down, they don't change. So maybe a 10% reduction in sales volume, you might get something like a 50% reduction in profit. That's what's giving you business risk. It's to do with the industry. It's to do with the type of company and cost structure. And debt and financial risk is very similar. Debt is also fixed. Debt also has to be paid. So if you go increasing the amount of debt to equity, or if we calculate in the proportion here, debt to equity plus debt, again, the more debt you have, the higher the financial risk. So this is the trick, what we're looking for in the actual exam. This is the question we're thinking about when we get given the CAPM model. We're thinking about, is the investment in the same industry as the current business? Has it got the same business risk? Or is it a diversification? If it's the same business risk, we can therefore use the existing beta. So going back to our company A, if we were investing in a travel business here, we could use exactly the same business risk, same beta, no problem. The The problem was we are diversifying into a new industry, so this involves different business risk. So diversification means we need to use here an equity beta to represent the business risk of the new industry. How do we do that? Well, step one, you saw earlier, we took a beta of another company, company B. What we now need to do is adjust this by ungearing it, calculating an asset beta. That means taking out company B's financial risk. We do it through that formula that we saw earlier on. So this is this adjustment here, calculating a beta asset. We then re-gear it. This is using our company's financial risk. Again, this is the formula we just used here. Then finally, we put it into our CAPM model and we calculate out our WACC. Well, let's go through each of these steps here. So let's first of all go back to our step one. So you saw earlier here, step one, we'd got our beta equity. Here it was 1.59. So let's let's go through each of these steps. So here's step one. We've got the equity beta from that company that undertakes similar business risk. So there it was 1.59. Then step two, what we now need to do is take out company B's financial risk. So let's go back to company B's financial risk. And here it was. Company B's financial risk was 1 to 2. This is debt to equity. So we've got equity, this is 2. We've got debt 1. We saw the tax rate earlier. So what we need to do is adjust that. So you can see, let's put it into the formula just here. So here's the 1.59 going in. And what happens is, the beta, when we take out financial risk, it should go down. So let's explain what we've just done just here, and let's think about, does this make sense? We have just taken out, this is company B's financial risk. So if we had no debt at all, look, the beta's come down, the risk has come down. So it was 1.59 before. When we put it in, you can see, look, we've just calculated here the beta asset. It's come down to 1.778. I always recommend my students, when they calculate this, to use 4 decimal places. So you can see, look, 1.778. So, okay, if we had no financial risk, if we had no debt, and we operated in commercial property, that is the beta that we'd be using here, 1.778. But of course, our company A has got financial risk. So what we need to do in the next step is add in our company A's financial risk. So let's explain what we're doing just here. We're now going to add in our company's financial risk, because as we saw earlier in the example here, look, we've got financial risk. You can see it. It was there. It was 2 to 5. So what we need to do, let's put in this beta asset. We just simply follow the formulas that we introduced earlier. So let's put in that 1.778 from the above. And then look, you can see now we need to add in our company's financial risk. So let's go back to company A's financial risk. Remember here, the debt was 2, the equity was 5. So let's put that in. Equity, we've got here 5, debt is 2. We just simply follow the formulas here, and look, you can see that when we now add in our company's financial risk, the beta now goes up. And what we've now got is this equity beta that we can now use in the CAPM model. But just before we get into the CAPM and last of all the weighted average, let's now think about what that number represents. It not only represents here company A's financial risk. Remember where it came from originally. We'd used 1.59 from a company that was operating in commercial property. So what this actual beta now represents isn't just our financial risk, it now correctly represents the business risk of the commercial property industry, the commercial property business in which we are investing. And look, let's just stand back a little second here and let's look at this step 3 and let's see, does the number make any sense? Because look, you can see if we look at company B's, theirs is 1.59. Theirs is slightly higher than the one we are going to be using in a second. The reason why theirs is slightly higher is because look, you can see here, their debt to equity is slightly more. They've got slightly more financial risk than us. Look, if you do a little percentage here of debt to equity, they've got, what, 50%? We've got less than 50%. So because we've got slightly less financial risk, the beta we are using is slightly lower than the 1.59. So it should make sense when we see the adjustments we've been making. The last final steps then here, once we've then got here this equity beta, we then need to put it into our CAPM model. This is calculating out what's known as the cost of equity. Earlier in the course, we spend a lot more time on the CAPM model and the calculations for the CAPM. And then last of all, we can then put this all together in the weighted average cost of capital. So weighted average cost of capital takes into account the costs of equity. So here it is, we just calculated it here above. We was also being told about the costs of debt. This was 6% before tax. We always have to adjust in the WACC for after tax. So this is this part just here, calculating the cost of debt after tax. And then we use a little simple weighted average and we get our final answer just here. So the discount rate we should be using, let's write it out now for the examiner. So company A's commercial project could be appraised now using NPV. And this 11.95, that's the WACC. That would represent the cost of capital or the discount rate to be used. So what I do is introduce these areas. It's only a brief demo, this one. Like I said, we spend a lot more time on the WACC, a lot more time on CAPM. I'm just showing you a technical popular area. Once we've gone through our examples, I then start going through detailed exam questions. Look, here's a good exam question here from December 2017, where look, the company is diversifying into a new industry. So again, we've got this change in business risk. Or if you want to see a more recent one, it doesn't just have to be changes in the business risk. We can also have changes in the financial risk. Look, they mentioned here that they're going to issue new debt, which would increase the debt to equity ratio. So financial risk is changing. So again, we see how the model, how the changes can be reflected. Greater financial risk, that will mean a higher beta. So we're always, as we're calculating, thinking about the changes being made. We spend quite a bit of time in this area. This is a very, very short, brief demo video, just showing you my notes and how I build your knowledge up. Introducing the areas, example practice, and then question, 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 question. Thank you for listening, and hope to see you guys on the course very, very soon. Thank you.